Thank you. Thank you, Khonsi. Good morning, guys. My name is Siboniso Nxumalo, and I've been at Old Mutual Investment Group for almost 20 years. Almost 20 years. Got in there in the mid-2000s when it was still OMAM. And I was this kid who had a passion for markets. Thought, I want to be an investor. And so let us get in there. Today, I'm going to talk about a few things. And we're going to talk about markets, we're going to talk about performance, but the title, Finding the Balance, Navigating the Paradoxes in the Investment Landscape. So, what are we going to touch on? There are 4 aspects. Global growth remains challenged, given short, sharp hiking cycle. The cracks are starting to show. So, we're going to talk about that. Interest rates. What do interest rates do, and how are they coming through? South Africa is at a point of peak pessimism, cyclically. So, in terms of South Africa, actually, there are question marks about South Africa. South African assets look cheap, but South Africa's got issues. We live with those issues. And then the next one, investment opportunities are present, though, because despite the environment and despite whatever goes on out there, our job is to go out there and find those opportunities. So I'm going to talk about those. I'm going to talk about tilting towards certainty, British American Tobacco, and Anheuser-Busch. But actually also South African assets. I'm going to talk a little bit about that. Price to deliver good returns. And then I'm going to talk a little bit about investor behavior. Because at the end of the day, actually, that matters. But before then, let's go to the dictionary and look at this idea of a paradox. What is a paradox? A paradox, in essence, is an idea that despite clear and valid rational thinking, leads to a controversial, contradictory, or irrational outcome. So what does that mean in investing? Let's start with the first one. Investors find comfort in cash. Yes, because cash is comfortable. Cash is like, times are uncertain, times are like a little bit worrying, so therefore I'm just going to keep it in cash. But actually, let's look at some reality. Long-term perspectives, a fantastic publication that we produce every single year. We are in 2023. Let's look at this and say the time needed to double your money. And so cash is a poor generator of wealth. You can see in South African equities, it should take 10 years, a decade, to double your money if you invested in South African equities. And for this, to calculate this, we're using historical returns. Now, if you think about what South Africa has gone through over the last 90 years, actually, those are not bad outcomes for investment returns. But if you put your money in SA bonds, bonds are cheaper, decent yields, especially now. But actually, using the last 90 years data, it would take you 41 years to double your wealth. And then, to double your real wealth in cash, look at that, 21, 11. That's a long, long, long time. And I'm not sure many of us will be around then if you really want to double your wealth. And so therefore, what does history say? History says, yes, cash does feel safe and gives us a nice warm, fuzzy feeling. The problem with it, it doesn't achieve long-term wealth generation outcomes. And again, another chart that comes from our long-term perspectives, long-term annual nominal returns in rands. And you can see it here. The lines with the green, that's where the cash is. Those are cash returns. And so you can see it from 50 years all the way to 5 years. Cash feels good, but actually doesn't give you an outcome that is good for your returns. And as volatile and as crazy markets are, actually, there are other assets and other instruments that give you a better return. And actually, let's talk about a time. I'll call this one a price for safety. Cumulative returns, January 2019 to 30th of June. And this is how, now remember here, we were saying, hey, when does cash work? Say 10 million rand invested in 2019 actually would have gone to about 12.7 million. But if you had invested in a large balance fund, actually you would have gone to 15 million. 2.5 million, that's a handsome profit for taking a little bit of additional risk. Now, in 2020, remember there was COVID. So yes, being in cash would have helped you. But the problem is, which we talk about again in this long-term perspectives, you would have lost out on the recovery. And timing the recovery, very, very difficult thing. But with that in mind, let's talk about a specific fund and then we'll get to the main objectives. Old Mutual Real Income Fund, an attractive alternative to cash. It's a good fund. It's delivered returns ahead of the real return objective. So it's beaten inflation. It has excellent capital preservation record, which I'll show you on the next slide. It's accessing more than just South African income assets. And actually, we changed the fee a little while back, and it's at a good fee. And at this present moment, great environment for this particular fund because South African bonds are yielding highly attractive returns. And so that's a fund worth checking up. And again, 99% capital preservation track record. That's a good track record. The only time it hasn't preserved is there in March 2020 and in 2009, where there were these deep recessions globally. But actually, other than that, it's achieved its objectives. It's better than cash, but actually it doesn't expose you to the markets. But let's talk about what's going on today. Let's talk about markets. Conflicting signal. This is the second paradox. We're going to spend a lot of time on this. This, a historic look at hiking cycles, interest rates. So these are the different interest rates. You can see them at the top, 1972 to 2015. And at the side, it's how much the interest rates have risen. And obviously, on the x-axis here is in how many days since the first hike. And you can see there's a different variety. Why do interest rates matter? Interest rates are the price of money. They dictate what money actually costs. When interest rates rise, you get an email the next day or an SMS from your bank telling you that if you've got any debt, well, you're going to pay a little bit more on that debt. So what does that mean? Well, actually, effectively, when interest rates rise, you become, as a person, a little bit poorer because it's going to cost you a little bit more. And over the last year or so, globally, this has happened to lots of individuals, in that interest rates have risen globally. So from a consumer perspective, everybody has gotten a little bit poorer. That wealth has been eroded. If you think about what interest rates were in 2020 to what they are now, what the average mortgage cost in 2020, what it costs now, there's a lot of pressure in the system because of that. And that's very important. But it's the same in corporates, in that a company borrows to go and expand, to go and do certain things all over the world. But it's the same that a corporate also is charged by banks on interest rate. And so therefore, the higher the interest rates, the less the profits of a corporate, which means there's less money to spend, less money to invest, etc. And so therefore, if you think of it like that, if consumers have less money when interest rates rise, if corporates have less money when interest rates rise, then actually, if you take that further and you think about it, how then will corporate profits rise and continue rising? And actually, since share markets are based on profits, there's an issue here. There's a disconnect. So we're saying, hey, if interest rates are rising, you must start looking forward and saying there's going to be an issue with profitability because there's just less money to go around. So now, let us take away the different colors and show you the current interest rate cycle. So we can see this is the current interest rate cycle. Interest rates have risen sharply and very quickly. Now, the ones that are, like you see the first one, the tall one, the one that's close to the green one, and the other one, these ones all led to recessions, and so did the other ones. And so, remember what I said, interest rates rise, there's a contraction there in wealth and spending power. It happens in people, it happens in companies, and profits come under pressure. When profits come under pressure, actually the economic cycle then starts to deteriorate, which means markets then can start to deteriorate. So then, how do we invest in a world where we can study from the 1972s to 2022 the impact in the economy of interest rate rises? So we know what's happened in each and every one of those. So when we look at the speed and the pace of this current interest rate hiking cycle, actually, what does that say to how we should position clients' portfolios? It says to us, hey, you've got to be cautious. There's less profitability out there in companies. There's less buying power in terms of consumers. And so therefore, invest cautiously. And so therefore, let's look at it. 30th of June 2022, the Old Mutual Balance Fund. How were we positioned in the Old Mutual Balance Fund? Total equity, 67%. Cash, 2%. Global were 27.5%, and global bonds were 3.2%. Cool. Interest rates have risen sharp, and they've risen very quickly. So therefore, what are we going to do? We know that profits are going to be lower. There is consumer pain, there's corporate pain. And so therefore, we've got to be cautious. So how are we positioned on the 30th of June 2023? We've taken off equity. We've reduced equity. We've said, if profits are going to be lower, well, then markets can't necessarily just keep rising. There's a disconnect there. So we've got to add some caution. We've put a lot more money in cash. Why? Cash is important Because if profits start coming down, asset prices start coming down, we can start executing that cash and buying assets. We did that very well in 2020. 2020, tough year, COVID came in, but actually we had enough cash to reposition and say, hey, these South African assets are very cheap, and that worked out very well. Global. We're going to talk a little bit more about going global. So total global allocations go from 27.5 to 32.2. And so, again, we've bought a lot more offshore assets. We're going to touch on that a little bit later. And then we've bought more in terms of global bonds. Global bonds weren't attractive to us a little while back. Now they've become a lot more attractive. So here it is. There's interest rates. They rise sharply. We know what the result of it is. There's just less buying power. We know that's going to affect profits. We have said, hey, we need to position client portfolios cautiously because we know what happens here. Okay, so then what happened? This is where the paradox comes in. Global equity, for the 6 months to June 2023, global equity is up almost 27%. Global bonds are up 12.6%, so that's okay for us. The rand, though, versus the dollar has deteriorated 10.8%. But you look at the South African assets, terrible returns. Okay, so we're saying, hey, the world is going to slow down because all those interest rate charts that I showed you, those were all actually US hiking cycles. Ours actually just mimic that, and so does everybody else globally, except for China in this specific instance. And so here we are, looking at this and saying, interest rates rise, let's be cautious. The market says, no, I'm going to keep running. I'm going to keep going. There, global equity, you can see that. And South Africa, obviously going through its own issues, that then causes pressure. And so therefore, we're saying, in theory, what should have happened is that markets should have come under pressure and rewarded our caution. But markets ran. That's the paradox. You see the fundamentals, the results aren't tying together. And so what does that mean? Well, look at our performance. 3-year performance, that's okay. That's reasonable. But 1-year performance is terrible. Our performance has been disappointing. But it's been disappointing because we've looked at the world and we've said we are going to be cautious, and markets have been stronger, much stronger than we have anticipated, so we've fallen behind. So the question is, are we right or are we not? Now, the trick about investing, in investing, being early is indistinguishable from being wrong. Because you can be early and miss out, and then at some point, it can all come right. So being early, indistinguishable from being wrong. We are not happy about this performance, so how did we get here? And how do we think funds performance? But before then, let's talk about what added to funds performance. So what contributed? Well, gold contributed. Because again, when the markets get a little bit rough, we bought a lot more gold. Why? Because gold is rewarded when things are tough. Banks, we bought South African banks. Actually, South African banks are yielding fantastic returns. It's actually much better to have your money buy the stock of the bank rather than have your money in the bank. It's rewarded. It's a good thing. Then Richemont. Richemont did well for us. We bought Richemont sometime last year. We thought the Chinese consumer would recover and would spend. They would spend on jewelry and all these luxury items. And they did. And so that worked out very well. But actually, what's on the other side? So what didn't work out as well? Total equity, like I said, we took risk off the table. The market still ran. So that didn't work out that well. South Africa versus global. South Africa really, really underperformed and actually was a major detractor to our performance. We're going to talk a little bit about that. It's our own goals in South Africa, load shedding, et cetera, et cetera. Naspers in process, we didn't have enough. We have a lot. It's the biggest position in the funds, but actually we didn't have enough. And then some South African holdings. And again, it comes back again to South Africa. South Africa didn't do well. And so therefore, remember what I said. In investing, being early is indistinguishable from being wrong. So then what will determine whether or not actually our positioning is right? Well, time. Because investing is actually about time. And so one of the things we're going to look at is, let's go back to this interest rates, the price of money. So the Fed, the Federal Reserve Bank, the most powerful bank in the world, typically tightens until something breaks. Tightening means it increases interest rates until something breaks. And you can see it. Each particular interest rate cycle, something tends to go wrong. That's the problem. That's what actually they're trying to do. Because there's too much inflation, you've got to slow the economy. You slow the economy by increasing interest rates, which means you crowd out everybody's potential to spend. You crowd out corporate. You make life expensive. And then something tends to break, and the economy comes right back down again. That's how you kill inflation. So inflation is persistent, it's a little bit of an issue, and clearly then off they went to increase interest rates. You can see here, very sharp rise in interest rates, and you can see what has gone wrong. SVB, Signature, First Republic, those are banks in America. Now, why does this matter? If you go back to 2008, financial crisis in 2008, the key then was it was a banking crisis. But if we go back there and we look, Washington Mutual Bank was the biggest bank failure in 2008. And then there was 94 billion in terms of 24 other banks which had failed. But if we look at here, if we step back, this is 2023. We had the second, third, and fourth largest bank failures in America, and the market still went on and performed. That's a little bit contradictory. That doesn't quite make sense. We know exactly what happened in 2008 when banks failed, but actually, hey, there are issues here. There are things that just don't quite make as much sense. So for us, we're looking at this and saying, hey, you've got to be cautious. You've got to be cautious. You've got to find your returns elsewhere. And so where to from here? Because that's what matters. So we do a lot of research in the team, and we do a lot of fundamental research where we go back in history, we look at what's going on out there in the world. US PMI is in recession territory. What does that mean? Producer Managers Index. And so whenever that is above the zero line, then the economy is expanding. So the economy is growing and things are good, and generally markets are good. But when it's below, actually the economy is contracting, which means that the market is in tough territory. And we can see it here. You can see that was 2020 over here. That was a contraction, but look where we are today. That was 2008 over there. The economy is contracting. So fundamentally, the environment globally, this is obviously the US, but there's a read-through, is contracting. So things aren't well in the global economy. Things aren't well in America. And so yes, the market's up 26.9%. There's a paradox in that. There's a contradiction. The next one is the probability of a recession. Now, one of the things that actually can predict recessions, economists are terrible at predicting these things, but actually the bond market is able to price recessions very well. And this is what this chart shows. So this particular chart historically goes and says, what is the probability of a recession? And we can see it now, it's just under 70%. Now, each time, historically, the probability has risen, there has been a high degree of recessions, which are the gray bars. And so therefore, 70%. So if I said to you, there's a 70% chance something is going to happen to you, I reckon you take it seriously. There's a track record here of the bond market being able to price in an economic contraction, a recession. And yet the market, globally, is up 26.9%. It's a strange thing, being a fund manager. You're sitting there, you're saying, actually, this is what the reality is in the world. The world is not as great in terms of markets. The market says, I don't care. I'm going to rise. We're positioned for the other one. And then one more, which matter, in terms of a credit squeeze, will lead to slower growth. So, again, in this particular one, these are American lending standards for loans. And so you can see when you go to the top, then the lending standards are tighter, and when this goes down, then the lending standards actually are looser. Now, again, interest rates are up, so people are under pressure. What does that mean? It means that the banks are going to be less generous in terms of lending because they know the economics are tough. So again, if you go back and think about it practically, if you had a mortgage in 2020, it costs a certain amount of money every single month. Today, it costs a vastly different amount of money. You haven't gotten an increase to buffer all of that. There's pressure. That's before you add the car loan and any other credit that you have. This is what's also happened in America. So banks are curtailing their lending standards. And so here, in the green, the loan demand is starting to fall. So if people can't borrow, they can't then buy more houses, more cars, they can't expand businesses, well then how are the profits going to grow? How our economy is going to grow? And again, does that not call for caution in how you invest? The next one, though, is telling the result of that. This is a number of US bankruptcy filings per month. Okay, here we are. You can see that. 2020, you can see where it was. We are back there. And historically, in 2008, we are heading towards there. So lots of bankruptcy filings. Times are tough. things are tough, market's up 26.5, we've underperformed. Can't quite tie those two together. So then how does one invest? We say, hey, you've got to invest with caution. You've got to be careful. So let's talk about South Africa, because South Africa is a big thing. So this is a ranking in terms of countries. You can see there South Africa is like number 18. So we're saying, hey, you know what? In the short term, South Africa is looking very attractively priced. But actually, there are some structural impediments. Structural impediments is a strong word. It's actually, things are tough. There are issues. We've got real issues in South Africa. If you look at who we are ranked with there, like Ukraine at number 19 is a country at war. Then we've got Brazil. Argentina's got 100% inflation. Now imagine 100% inflation in a country. Prices increase 100% every single year. People don't save in Argentina. Why? Because why would you save? You're not going to get 100% return every single year. Venezuela, again, another country that's got some war. So we are in bad company. There, Turkey and Colombia are above us. They've got other issues. So as a country, actually, we aren't looking good. So you can see our combined ranking. I'm going to pull all of these out. The orange bars are the ones that matter because they show that actually on a one-year change, we are deteriorating. Now, for 3 years, it's a mixed picture. But actually, in terms of economic risk, financial risk, and institutional strength, there are some issues in South Africa that we've got to take care of. The biggest issue is this particular one, Eskom. I didn't check the load shedding schedule here, but that's what we do now. We go to places and we're like, oh, how does the schedule look like? What's the problem with Eskom? The problem with Eskom is this, is that back in the heyday, available energy from the Eskom power plants, these machines that burn coal and then generate electricity. 7% planned outages, 3% unplanned outages. This was good. This was the heyday. We just didn't know we lived in the heyday. But it was good because we used to turn on the lights and the lights came on. But actually, we now realize we took this for granted. But where are we now? We call this Mayday. Available energy, 55%. Planned outages, 10%. Unplanned outages, 35%. When you don't invest and take care of your infrastructure, at some point, it comes back to bite you. So that's where you are. Eskom is an issue. And there's a cost to Eskom being an issue. So 3.9% is the estimated cumulative impact on GDP in South Africa between 2022 and 2025. So there's a cost. We could have had all of that as GDP growth. But actually it's not happening. Why? Because, power is not reliable. But what's interesting here is that in investing, you've got to look at the present, but you've got to look at the future. Because it's about what you are positioned for, not what is actually occurring today that matters when it comes to investing. Now, this chart is depressing. So 2023, as a country that needs to grow, we're going to lose 2 percentage points in GDP. But what's interesting here is to say, hey, 2024, we lose 0.8. 2025, we lose 0.4. Why? Because actually, remember what I talked about, peak pessimism. If I look at this, if we look at what's happening in energy, we see peak load shedding, stage 6 and stage 8. We've had those, and it's already starting to improve a little bit. But actually, in 2024, Kusile and Koeberg returned to service. So that's stage 2 to stage 4 that we're seeing. But actually, by the time we get to 2025, renewables start taking over. And actually, load shedding becomes a thing of the past. So when you're investing in South African companies, you know that today's costs are huge. So Pick n Pay reported its results the other day. It was 2 weeks ago, last week. And they were like we've spent 250 million rand on diesel costs to keep the shops open and to make sure the fridges are working. Looking at this, it says next year they're going to spend less. The following year, actually they'll hardly spend anything. So from a profit perspective in a company, that's just going to keep improving. Because that's how you invest. You're investing in future profits. So actually, that is interesting to us. Because if we can buy that share at a low price and profits are improving, that's a good equation. Also, the other thing that I want us to notice is that South Africa is an interesting country because we can get very pessimistic on South Africa. When I look at this renewables thing, I have a thought. The thought here that South Africa is a fascinating country in the sense that we are privatizing the country via stealth. So, the public hospitals failed, Then there were private hospitals that worked extremely well, if you could afford them. Then, education was failing. Then there were private schools. Then ESCOM's failing. And then there's private, we put solar panels. Companies are coming up with how to run your renewables. It's one of the most fascinating things about South Africa as a country. We always question ourselves. Actually, how it's going to fail, it's going to fail, it's going to fail. But it doesn't fail because actually the businessmen and the citizens of South Africa are able to say, well, we'll take that from you as a state and we'll do it ourselves. And then we go back again. Like I said, from an investment perspective, companies are going to struggle less. And so therefore, but the issue is, if we look at opportunities in South Africa, in terms of government bonds, the yields are fantastic. We're getting 2 times the real yield. So that's a good return in South African bonds. You're getting almost 12% for investing in government bonds. That's a good thing because everybody's pessimistic. And so the price is low. That's attractive to us. If I come to you and I say the world is risky, I'm going to give you 12% on a government bond, that's a good return. It's difficult to get that in equity markets. South African banks' dividend yields are 40% higher. Clothing retailers' dividend yields are 10% higher, and the banks are 20% cheaper, and so the clothing retailers. So we've tilted our portfolio towards the clothing retailers. We're going to talk about that a little bit later as we close. So we think South Africa is prime for positive change, but you've got to think differently in order to see it. One of the things, so then where do we find returns? Where do we find investment returns? Because our job, I might come and say all these things, we've got to find returns. There. So what we've done here is these are different recessions, 1990, 2001, 2007, and 2020. And we looked at shares and said, how do shares perform in tough times? Because interest rates rise, usually there's a recession afterwards, especially when they rise with the speed that they've risen with. Say, hey, company, British American Tobacco. So it tends to outperform that middle bit there into a recession. Why? Because, well, they sell an addictive products. The smokers will smoke. Whether it's good, it's bad, they will smoke. So therefore, how do you grow your clients' wealth? You associate with a company that doesn't collapse during the recession because the people will buy it. So we're finding this. It's the second biggest holding in our clients' funds. Why? Because actually, we've got a proof here. They sell a product that people are going to buy, whatever happens. Another one, similar type company, Anheuser-Busch InBev, largest beer company in the world. Again, it's the same thing. Whether it's a recession, whether times are good, times are bad, no, the people who want to drink will drink. And that's okay. That's okay. It's actually a good thing. In terms of us investing, we must invest. We must give clients returns. Because I've just talked about how difficult it will be to find them. But sometimes they're found in some obvious places. This is one of them. Bought South African breweries a couple of years ago. It was a terrible deal, but hey, the company is a decent company. Another one, though, because in this particular instance, what's happening, we're starting to buy retailers because the consumer is under immense pressure at this moment. Interest rates are up, consumer wallets are under immense pressure, but actually, this particular chart, it's a complicated chart, but it shows you when interest rates peak, and 2 weeks ago we had a pause. These consumer companies, generally, they outperform 57% of the time after the last hike. We might have had our last hike. So therefore, if these companies outperform, we're starting to build positions in them. And we've seen it over the last few weeks. Suddenly, the South African retailers have woken up. But again, remember, what's going to grow their profits? One, the next step is interest rates, is they level out, then they start dropping. People then have more money. They're going to go and shop and spend money on clothing. It's a good thing. People must look good. And then on the other side of it, remember, these companies have spent a lot of money on load shedding too, making sure that they can keep running. Again, that's a good thing because remember, their profits are depressed. So going forward, because that's what investing is about, you've got to look ahead. You've got to look past what today looks like. And so therefore, again, we're buying lots of these companies. We like them. We like them. Increasing those opportunities. So go shopping. So basically smoke if you smoke, drink if you drink, and then make sure that you go shopping. That's going to work out well for your investments. It's called alignment. That's what it's called. We must be aligned. So, Old Mutual Balance Fund, as I sum it up, June 2022, June 2023, our positioning. This is the South African side. On this particular side, you can see we've taken equities off. So yes, in South Africa, I'm saying we're investing in South African equities, but actually we've reduced our equity exposure because we're saying, we've got to be nervous here. You can see we've bought lots of government bonds, and again, we like government bonds. Anything that yields close to 12% is okay. and then we've got a lot of cash, like I said, you've got to prepare. If things slow down, assets get cheap, we're going to buy them. That's how you position. That's how you position. You've got to be preparing for the next cycle. Global, we've gone offshore a little bit. One of the things I want to say about this offshore thing, and I'm going to say it also in the next slide, is that you've got to think deeply about this idea of going offshore. Because once you take your money offshore, you expose yourself to different currencies. Now, what's interesting about this particular one, all those charts with interest rates and banks failing and all of that are all American. Now, if you take your money offshore, generally, most of the, what is called the MSCI EQI, All Country World Index, 60% of it is America. And so therefore, yes, South Africa's got issues. Its assets are cheap. But the idea of like indiscriminately just saying, if I go offshore, I'm better off, don't be so sure, because clearly something's happening. The world is tough. So we've got to be thinking very smartly about how we're positioning. Again, in the balance fund, how? Unpacking. So in South Africa, we always think that the market is the economy. These are not the same things. They're two different things. So when we look through our funds, the Old Mutual Balance Fund, we're saying, in terms of listing, companies being listed, 67.8% is South African companies, and only 32.2% actually is offshore exposure in the fund. But actually, you've got to look further than that and look through where the company's economic interests are. So if you take a company like Richemont that sells all this very, very expensive stuff that if you do a bad job with your wife, you must go and buy all these very expensive things to say, I apologize, or I love you. Actually, that company doesn't make money in South Africa. It makes money offshore. The mining companies in South Africa that mine the platinum, the gold, the iron ore, etc., even the coal ones, they don't sell the stuff in South Africa. They sell it offshore. And so therefore, our starting position is why the South African economy can be bad and that the market can be okay, because our starting position, we have a lot of companies that are listed in South Africa but actually make their revenue elsewhere. And so your starting position is much higher, actually, with an offshore component than you would think. And so it's something that's worth thinking through. I'm not saying don't go offshore, but I'm saying where you're starting at is different. And then the last, second last slide, again, long-term investment lessons. You must get this publication. It's a good publication. We've even got videos now, because these days you can't just like issue paper. You know, humans, we have gotten a shorter attention span, so we've got to find innovative ways. So on YouTube there, we've got these lessons put out. The first thing you always want to beat is inflation. Inflation is very high at the moment. And again, it's eroding wealth. That's why interest rates are up. And so, again, we've got to be careful about inflation. How are you positioning? And there's inflation that the Reserve Bank reports, but then there's the inflation that real people that you guys deal with report. Again, if interest rates are up this high, their real year-on-year inflation is putting pressure. So how are we finding returns? It's why then I speak about a starting South African bonds, that's attractive to us. Looking at British American Tobacco and Anheuser-Busch, that's attractive. So our mindset is to say, yes, we want to grow their wealth, but we're going to start by looking in a different place where there's a little bit more certainty. Where we aren't finding returns is resource companies, because those profits are coming under pressure. They do not do well in a recession. And actually, partially what explains our underperformance. We just haven't been there. We haven't positioned clients there. And so that is it. I could even go through all the others. But I'll conclude. Global growth remains challenged. Given a short, sharp hiking cycle, the cracks are starting to show. And I've shown you the cracks are starting to show. SA is at a point of peak pessimism cyclically, but there are issues in South Africa. There are real issues. The point, though, is that there is some level of improvement, but you've got to think very carefully about where you're finding your assets. Investment opportunities are present. They always are, especially at attractive prices. We're tilting towards certainty, British American Tobacco and Anheuser-Busch, and we think South African assets will give you good returns cyclically in the short term. But investor behavior is key. You've got to stick to a long-term plan, and cash is a poor long-term asset. Thank you very much. That is me.